Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of how sustainable investing shapes the future of our planet and economy. Deforestation for agriculture and development. Investments in palm oil plantations, cattle ranching, and large-scale farming projects have driven deforestation in regions like the Amazon and Southeast Asia. Vast rainforests, often called the lungs of the earth, are cleared to make way for cash crops or urban expansion, disrupting local ecosystems and releasing massive amounts of carbon dioxide into the atmosphere. Fossil fuel extraction and pollution. From coal mining to offshore drilling, energy projects often leave behind a trail of devastation. Oil spills, such as the infamous Deepwater Horizon disaster, contaminate oceans and coastal areas, killing marine life and harming local communities. Beyond visible spills, everyday operations pollute air and water, leading to long-term public health crises. Mining and resource exploitation. Investments in mining for minerals like gold, lithium, and cobalt come with enormous environmental costs. Strip mining and toxic chemical runoff destroy landscapes, poison water supplies, and harm wildlife habitats. While these materials may be crucial for modern technology, rushing extraction without safeguards magnifies the ecological damage. Real estate development in sensitive areas. Expanding urban infrastructure often means paving over wetlands, forests, and other ecologically sensitive areas. These investments disrupt biodiversity, escalate flooding risks, and reduce the planet's ability to absorb carbon naturally. Coastal developments are particularly harmful as they encroach on fragile marine ecosystems. Each of these examples highlights a pattern. Investments with no regard for environmental impact often create ripple effects that are costly to undo. When ecosystems collapse, the consequences don't stay local, they affect global stability, food chains, and even climate regulation. Economic repercussions of ignoring environmental risks. Looking the other way on environmental issues isn't just bad for the planet, it's a gamble that can erode profits. Here's how neglecting these risks can boomerang back to investors and companies alike. Rising costs from climate disasters. Ignoring environmental warnings can leave industries unprepared for climate-related disasters. Think about it. What happens when hurricanes intensify, wildfires rage, or floods destroy critical manufacturing hubs? Insurance claims skyrocket, supply chains break down, and recovery costs add up. For instance, businesses in areas prone to extreme weather have already faced billions in losses due to climate change in the last decade. Regulatory crackdowns and fines. Laws and regulations around sustainability are tightening worldwide. Investments in high-emission industries are increasingly penalized by carbon taxes, stricter permits, or outright bans. When governments step in, companies that failed to adapt to greener practices face hefty fines or struggle to stay competitive. Market backlash and damaged reputation. Consumers and stakeholders are more eco-conscious than ever. Businesses tied to environmental damage, whether directly or through their investors, risk boycotts, plummeting sales, and shareholder revolts. Brand loyalty is hard to rebuild after being labeled as environmentally irresponsible. Asset stranding. Fossil fuels, coal plants, and similar industries are at risk of becoming stranded assets as the world pivots toward renewable energy. These are investments that lose value because demand shifts to greener alternatives. For example, coal mines and oil fields once seen as lucrative may become liabilities as cleaner energy sources continue to dominate. Long-term productivity loss. Damaged ecosystems also translate to reduced economic productivity. Overfishing depletes ocean stocks, deforestation erodes the fertile land needed for crops, and polluted air reduces worker health. Industries reliant on natural resources directly impact their bottom line. Once those resources are gone, rebuilding them isn't cheap or easy. For companies and investors, the message is clear: overlooking environmental risks is no longer a viable strategy. Whether through regulatory pressure, unexpected climate events, or shifting public sentiment, unsustainable investments aren't just harmful, they're risky bets that can drain profits and erode trust. Making smarter, greener choices isn't just the ethical thing to do, it's the only way to ensure long-term financial stability. The role of ESG ratings in green investing. ESG ratings have become a key tool for investors aiming to align their portfolios with environmental and social priorities. These ratings offer a way to evaluate how businesses perform in critical areas like sustainability, workplace practices, and ethical governance. But how are these ratings determined, and do they always tell the full story? Let's explore how ESG criteria work and the challenges these systems face. How ESG criteria work. ESG ratings are based on three main pillars: environmental, social, and governance. Each of these categories includes detailed metrics that assess a company's actions and policies. Here's a breakdown. Environmental. This focuses on how a company impacts the natural world. Key metrics include carbon emissions, energy efficiency, waste management, water usage, and the company's impact on ecosystems. For example, a business investing in renewable energy or adopting net zero emissions goals would score higher in this category. Social. Social criteria assess how a company treats its employees, customers, and communities. This includes labor practices, diversity efforts, community engagement, and respect for human rights. For instance, companies that promote fair wages, gender equality, and workplace safety typically get higher scores. Governance. Governance looks at how a company is managed and how decisions are made at the top. It measures leadership transparency, board diversity, anti-corruption policies, and shareholder accountability. Ethical business practices, such as avoiding conflicts of interest or disclosing financial activity openly, are crucial here. Rating agencies collect data from publicly available sources like company reports, government filings, and third-party research to score companies on these pillars. Major providers in this space include MSCI, Sustainalytics, and Bloomberg. Once companies are scored, they're often assigned a letter grade, numerical rank, or percentile rank that summarizes their ESG performance. For investors, ESG ratings act like a compass. They don't just showcase which companies are sustainable but also highlight risks tied to poor environmental or social practices. If a company scores low on ESG, it might face future challenges like stricter regulations, consumer backlash, or operational disruption, all of which could hurt its profitability. Criticisms and misuse of ESG ratings. While ESG ratings provide valuable insight, they aren't without flaws. Critics argue that these systems sometimes lack consistency, transparency, or objectivity. Here are a few key concerns. Inconsistency across providers. Rating agencies often use different methodologies, which can lead to conflicting scores for the same company. One agency might reward a company for setting carbon neutrality goals, while another might penalize them for failing to meet specific environmental benchmarks. This inconsistency can confuse investors instead of helping them make informed choices. Lack of transparency. ESG ratings are only as good as the data behind them. Sometimes, companies provide incomplete or overly polished information in their sustainability reports, making it hard to separate facts from marketing. When rating agencies fail to disclose how they evaluate these reports, it raises questions about the reliability of their scores. Greenwashing. Greenwashing happens when companies artificially inflate their ESG credentials without making meaningful progress. For instance, a corporation might highlight a small tree planting project to distract from its high carbon footprint. If ESG ratings don't thoroughly examine such practices, they risk rewarding surface-level efforts rather than real change. Omission of smaller players. Big corporations often dominate ESG ratings because they have the resources to publish detailed sustainability reports and hire teams to market their good deeds. Meanwhile, smaller businesses that might be genuinely sustainable don't always make it onto the radar of rating agencies. Focus on profitability over impact. Some critics argue that ESG ratings still prioritize financial performance over true environmental or social progress. A company might earn a favorable score simply because it mitigates risks to its bottom line, even if its carbon footprint remains significant or its community benefits are minimal. As ESG investing continues to grow, the demand for more robust and transparent rating systems has become louder. Investors need tools that are not only reliable but also capable of distinguishing between genuine efforts and superficial gestures. Without better standards, ESG risks being dismissed as just another marketing tool. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.